Hey YouTube, this is Zach with Achilles Financial, and today I'm going to walk you through why the treasury yields and bond yields in general are having an impact on stocks, and in particular the tech stocks. You can see that late last year into early this year, we did see a steady increase in bond yields, in particular treasuries. Now, treasuries are one of the ways that the US government has the capability to raise debt at a relatively low interest rate. Now, if you'll recall that the Federal Reserve is continuing to increase interest rates, and that is going to be the rate, or rather the overnight lending rate that they are lending to banks so that they can make money on the investments that they have and the loans that they are issuing. Now, for what I'm showcasing here on the screen, when the treasury rate is doing well, that generally means that the Fed is doing a good job at fighting inflation and that people want to invest and there is demand for these treasuries. Now, early in March, following a very strong February, we saw the large increase in overall rates lead to a sharp panic in banking sector, in particular in Silicon Valley Bank, amongst others, who had these large securities portfolios who were showing these massive unrealized losses causing capital issues, which led to a run on the banks. Since that point in time, due to the fact that we've continued to have large forms of liquidity, we continue to see that the 2-year yield as well as other treasury yields and bond yields have been relatively stagnant over this time frame. However, as of today, at various points in time, the 2-year yield was over 5% as soon as today. Now, while it did not hold that level, it did crest that 5%, which means that you were able to buy risk-free. This is backed up by the U.S. government, so the only time that they're not going to pay you back is if they default, at which point in time we'll probably have other concerns and considerations. But if this were to drop, you were going to see, or if this were to fail, you would see a lot of issues. So what this means is that when the 2-year yield is over 5%, a lot of institutional investors, or as this rate in general goes up, a lot of institutional investors and a lot of individuals are going to continue to look at and evaluate, can they move money over into this risk-free yield? A 5% yield compared to a large increase in stock valuations like we've seen this year, especially in tech, where you've got some stocks like Nvidia, Tesla, Meta, all going up 100% seems trivial. However, if you're looking at larger investors, this 5% risk-free is going to be very, very attractive. And that is because, again, if you have $1 million, you're bringing in $50,000 risk-free over the next 2 years, and you can just multiply that out. One of the other large considerations is this duration risk. So a lot of individuals are going to want to have the 10-year, or rather the longer form money available to you. So one of the things that they're going to do is say, why in the world would I get the 2-year for this rate when I can get the 10-year for this rate? Now, the 2-year and 10-year bond yields are something that are constant, or individuals are constantly going back and forth about, as this spread is the primary recession indicator. So at this point in time, you can see that 10-year yields are back over 10%, which they have not been since, once again, late February, early March, or back over 4%. So what we're going to be looking at is, again, going to be that spread. Now, the spread that you're going to see here for the US 10-year yield, or the difference between those two, is going to be the inversion. So when we're talking through the inversion and the capabilities that you have there, we'll see this recession indicator. So the tighter that spread generally means that the economy is doing well and things are going nicely. However, we've currently been under that 0% for the better part of a year and a half now. And again, when it's under 0, when they are inverted, that means that there is going to be duration risk, and that means that individuals, or this is our recession indicator. So what does it mean when we say that this is inverted? What this is saying is that right now, you are going to be paying a premium for the shorter yield over the longer yield. And when you think of risk management, you always want to take the longer duration, because that generally means that there's going to be less of a risk there because you have more opportunities to get paid back. Right now, what the yield curve is saying is that the Federal Reserve is going to lose its inflation fight, and they are going to have to drop rates, which individuals think that means that the current or the long-term rates are going to be at a discount to the short-term rates at this point in time. So that's why they're loading up on that duration. And you can see that the spread has widened to some of the largest points in times that we've seen since all the way back in the 1980s. So that is a massive impact there. So what does this impact have on the stock market? So what I'm showing here on the screen is SPY. This is one of the largest investment ETFs that are available to you. And you can see that right now, if we even look at the chart and we showcase kind of the year-to-date performance available here, the overall market has showed a markedly strong increase from around $380 at the beginning of this year to, at this point in time, nearly $440. Now, the bulk of the performance associated with this fund is going to be attributed to the top stocks, but you can already see on a 2023 basis that it is up nearly 10%. Now, something that I would call out as we're reviewing this and evaluating this information, that it is doing incredibly well. However, if we look at the portfolio, we can see that really most of this performance is coming from these large cyclical tech stocks. Now, something that I would call out when we're looking at these technology components is that most of them are seeing earnings actually decline and sales are slowing as well. That sales growth year over year is continuing to decline. However, that hasn't stopped 130%, 144%, 190% returns, as well as a number of the other stocks that you see here, which are posting very strong returns as well. However, we begin to ask the question of, does it make sense, or is this sustainable for large-scale funds to continue to receive or can you beat a 5% return risk-free compared to what we're showcasing here? In particular, for the S&P 500, current expectations are it's going to end the year around 450, or I've seen estimates around 470, and both of those items are really going to be less than 5% from the current 440 that we're at today, especially that 450 number. So the question is, do you want to hold this? Do you want to risk even a 10% drawdown? Or if you're a large-scale money maker, you are instead going to come up here onto the TD Ameritrade, come over to the bonds and CDs options available to you here, and you can see that we've got CDs available, but even the US Treasuries, which are paying incredibly nice rates, available to you here, although not all are beating the CDs like we saw at the beginning of this year. This is one of the reasons why we continue to see large sums of money move into these money market funds, as well as into treasuries and CDs instead of the stock market. As that liquidity begins to drain, I would expect to see that have a negative impact on the stock market. That being said, this is all just my conjecture. This is something we expected earlier this year to occur, and then we saw a large lump sum of liquidity as the Federal Reserve backstopped a number of banks as some of those banks were failing. And so this is all conjecture, but I do believe it's a matter of not if, but when we can expect these rates to keep climbing, especially if we're expecting another 25 basis point hike here in the month of July before potentially seeing another one later this year. So this is what we'll continue to watch. And I'd love to know in the comment section down below if you have purchased any bonds or CDs, and if you would consider moving those over as opposed to holding on to equities like US stocks. Let me know. Talk to you later.